Good morning, friends. Welcome to the Trade Speakeasy. For those of you who are already in our Trade Speakeasy Telegram groups, you're getting my morning updates about what's happening globally and at the macroeconomic level. But I thought it would just be nice to get a little video out there to talk about what's happening from a wider perspective. So as we know, during the height of the COVID pandemic, about 10 trillion of monetary and fiscal stimulus was pumped into the economy. And from that, only 2.3 trillion was created growth. And about 1.5 trillion of that was actually just going to higher prices. So it's basically just eaten up by inflation. And as we all know, inflation wasn't transitory, that inflation has continued to be sticky. And even though we've had rate hikes and now we've started quantitative easing, that we are continuing to see inflation remain high. And so the big question is, how is that going to affect us as we go into this next earnings season? Because I do think that this earnings season is going to be extremely important because it's going to indicate to the Fed both what is happening with companies in the US economy, but also what is the purview of those who are continuing to invest in equities. And that really gives a big signal about the psychology of current investors and those who are really putting their money back into the economy, right? So first, what we've seen is that during the pandemic, a lot of families utilized some of that stimulus money to pay down credit card debt. Either that was because of the funding that they received or because their lifestyle had just changed significantly because of the lockdowns or being at home. And at the same time, now that it has been 1 year since the last, or a little bit over a year since the last check went out, we're starting to see the average American family really changing their spending habits back to how they were before COVID. So we're starting to see families reutilizing credit cards, and that credit card spending is on kind of those core spending issues: food, energy, clothing, shelter. And so that is the stickiest part of this ongoing inflation, because obviously the general income of the American family is insufficient to meet those needs. But what we're also not seeing is that families in like the upper 10% of earners, that they still have a lot of discretionary funds and they're still able to continue their demand. And so that kind of increased rate of, or ongoing rate of demand is just too much because of the lack of supply, whether we're talking about energy and what's happening in Russia, or just the supply chain issues, or the lockdowns in China because of the COVID zero policies. The thing that the Fed wants to see is that, there's tightening going on across the board. And so the fact that we continue to see some families in the upper earning quadrant of the economy continue to be able to press for demand means that a lot of that frothy money still hasn't come out of the economy. And one of the ways to do that is for those who are living on, they have a lot of risk assets. Maybe they've been living on the dividend payments from their equities holding. One of the ways that we can start to see that there is a bit of a demand destruction is on twofold. So the Fed can affect credit spread. So basically it becomes more difficult for corporations to be able to borrow easy money. And that basically forces companies to start tightening up their activities, focusing on productivity and growth. And then on the other side, for those who maybe have really large portfolios of equities and other risk assets, that as they start to see the dividend payments maybe start to dwindle, well, then they start to become a lot more cautious about how they are spending their income from their portfolios. And so that just helps to continue this course of demand destruction. However, we are starting to get a very strange signal from analysts, because even though earnings we still have very high projections considering the overall economic situation. So we have seen earnings projections come down, but probably not far enough in relationship to the wider economic dynamics that we're looking at. But many analysts are still seeing or still saying that they're expecting like a 22% growth in 2022 for consumer discretionary. And to me, that just doesn't make any sense. So I just want to share with you some of the charts that I'm looking at for those top holdings of consumer discretionary, or we could look at XLY, but like Home Depot has been in a downtrend since the beginning of the year. And even when it's had some of these bullish moves or bear market rallies, it has really not been able to flip any of the moving averages into a positive direction. It turned all of the EMAs negative back here in January, and it's continued on a downtrend. McDonald's is another one. Though it hasn't had as significant a downtrend as Home Depot, we are still seeing that it is making lower lows, though it is, making lower highs, even though it is making higher lows. So we're getting into this wedge formation, but overall we are down for the year. Then you look at something like Amazon, which yes, it is testing these bottoms, and now it is coming back up to the moving averages, but we haven't seen any sustained bullishness from Amazon. And really all of 2021, it was just flat, basically already gave everything back anyways. So Tesla is pretty much the same. It's still on this downtrend, though it has a lot of volatility. So when we start to see these gamma squeezes, we do get these, very strong propulsions to the upside, but they are, they don't sustain themselves. So it's not really positive growth if you're just, have these blips on the chart where you see value, the value of the stock spiking, but the true valuation of the company is continues to decline. And so one of the things that I think is curious is, if the Fed needs to see that there is a demand destruction happening, then they really need to see in those, let's say, non-essential areas of the economy, like consumer discretionary, that the spending habits of people have changed, that there is not continued money going into those areas, even though that is bad for the wider economy and for jobs and that aspect. But just for the Fed to be able to see that there is a true demand destruction happening, because across the board, across the US economy, that Americans from every class are having difficulty really purchasing items beyond those core items. So I think that right now we continue to face this dichotomy in the conversation where, yes, on the macro level, we're seeing a lot of problems, a lot of pressure. The charts are even showing that we've had a lot of downward activity. But the fact that here at Q2, we're already having analysts giving us positive growth projections, even though, our earnings are projected slightly, have been downscaled, and even some of the dividends have come down. But the overall feel is that there's still this kind of optimistic, energy from analysts that things could then end on the year on an uptone. And I think that that's actually quite problematic, because it is literally the very opposite of what the Fed needs to hear. Because if we are all still optimistic that we will all still have enough money to be able to do the core things plus extra things, then it basically communicates to the Fed that actually we are not in a trend of demand destruction. And since the Fed cannot control supply, that pushes them to continue to tighten, because they need the average American to feel that they have to be moving within a tighter budget, and that they continue to kind of push off the demand for non-essential products, but even essential products. So I'm not sure why analysts are already giving such positive feedback, because even companies, when we look at the CPI numbers in relationship to the PPI numbers, the thing that we're seeing is that costs are going up for corporations, but they cannot pass on those costs to customers. And so that literally means that their that their profits are going to decrease, and that there isn't necessarily going to be a year-over-year growth. So I think that what this does, especially for areas like consumer discretionary and tech, where they tend to be more growth sensitive, that they require more access to easy money, or they need to be able to borrow more money in order to keep their systems running appropriately, to be able to warehouse products. That essentially what's going to happen is that these companies are going to face those credit spreads. They're not going to be able to access that money as easily, but we are not going to see these companies just bounce back. And I think it's unhelpful when analysts are giving us such high projections for the year, because it will cause those areas of the consumer discretionary, like the Amazons, McDonald's, Lowe's, Home Depots, to possibly start whiplashing and have bigger bounces. It's essentially going to create greater volatility, because it is giving a signal that there is going to be growth, when all the other economic signals are saying that there is not going to be growth. And that then gives mixed signals to investors, because it gives them the signal that now is the buy time for consumer discretionary. And I think that then communicates to the Fed, well, if we all have this extra cash lying around to be buying up shares in consumer discretionary, or to even be spending in that area, that it communicates something totally differently than what's actually going on in the day-to-day economy and for the average American family. So that was just one of the kind of wide eye view pieces of data that I thought was really important when looking at, what is the Fed's perspective now that stimulus has really come out of the economy, now that we're starting to see more honest charts where there's not as much of that easy money in corporations, but then, having this kind of caution sign that analysts are still not accepting the economy as it is and the macro dynamics as they are. And because of that, we possibly won't get the downgrading in those earnings projections and in the dividend projections that we need to see in order for the economy to really absorb the conditions that we are actually in, instead of these overly positive, analyst view or sentiment, when the rest of the economy is not looking at the economy with that much positivity. And we need to start seeing things align. And once we start seeing things align, I think once we start seeing that frothy money come out of the equity markets and fair value, then equities going back to more fair value prices, that then you will start to see a much stronger alignment between the average American's kind of outlook on the economy and what the possibilities are in the equities market for ongoing investment for long-term buy and hold. But right now, I think we're going to get a lot of whiplashing, because we're getting really divergent signals from the actual economy and then from analysts. So I hope that helps. For those who are interested, feel free to contact us or to reach out to us at the Trade Speakeasy. We do morning updates regularly in our Telegram group. So if you would like to join, just shoot us a message on here in the comments on YouTube, or at our Instagram channel. All right, bye for now.